basically from election day, this market's been strong. And I think it was looking at the Trump policies, which are more pro-capitalist, more pro-market. It's a recognition that we're going to get away from a lot of the policies like open borders and things that seem to be hurting this country. You're going to see deregulation. You're going to see tax cuts. Just across the board, you can see that the policies are going to be 180 degrees from what we've had the last 4 years. Generally are good for the economy and therefore good for the market. Some people will quibble with, you had some of this for certainly the last couple of months, is people talking about that Trump's policies are going to add to the, more to the deficit than his counterpart would have done. And that it's, you're going to end up with real problems with debt and deficits. And I would argue that it's a lack of understanding of how supply side economics actually does work, really going all the way back to the years Reagan cut taxes. The left and frankly most academics want to poo-poo tax cuts as raising revenue, but if you look at the history, we've had big tax cuts, which means marginal tax rates get cut. Taxes don't get cut. People want to look at a static model and say if you cut tax rates, you're going to get less revenue. No, because tax rate cuts lead to more activity, lead to a stronger economy, lead to more capital gains, and therefore your revenues go up. It's like a retail store or retail chain saying, we want more volume, so we're going to cut prices. You cut and then you get higher volume out of that. So it's a mistaken belief, and most of Wall Street has bought into it too, that supply side cuts do not generate more revenue, they generate less revenue. What you really have found in, again, looking at the evidence, is that our deficits are growing because of a spending problem, not a tax cut problem. So if we get Ramaswamy and Musk coming in, actually taking $1 trillion or $2 trillion out of the government, and if we get kind of knock down some of this waste and fraud, you actually can see that government spending is going to be going down in spite of some of these aggressive programs. And at the same time, the tax revenues are going to be going up, even though tax rates are being cut. The bond market backed up on that fear that, Trump is going to, spend us into more problems and tax cuts are going to lead to less revenue and bigger deficits. And so we had that backup from 360, I think, to 450 on the 10-year, mostly on the basis of Trump policies. And I think you're seeing now that that correction has run its course. A little bit of the rhetoric is moving back the other way and beginning to not get so worried about growing debt and deficits. I think we're going to be positively surprised in terms of what his policies do bring. Now, that being said, I'm calling for a global bust, as you know, and a global bust is going to be met because a global bust is something bigger than anything we've seen in post-World War II era in terms of a downturn and financial crisis. The response to that is very predictable. It will be more money printing than we've had in the history. So more than 2008-9, more than 2020. You could see 20 trillion out of the Fed and proportionally similar out of every central bank because they'll be dealing with a free-falling financial system. When that happens, and it'll be matched, I think, with a similar type fiscal response so that you're going to have massive spending, massive money. And so take Trump out of the equation and just look at that. And it's going to be very hard to argue that, 3, 4, 5 years out, we're not going to have higher inflation, higher deficits, higher debt, all of that, in spite of what Trump, I think, will be delivering. So, but it would have happened under any president. I don't view that as part of the policy. I view that as kind of a predictable response to a bust that's going to come as a result of decades, and I mean many decades of overspending, poor policy, overborrowing. The leverage in the system, both public and private, is off the rails. I mean, it's so much higher than anything we've seen before, including 2008-9, and that's why I think we get a global bust. Yeah, I actually raised my targets in my October letter, my fourth quarter letter. So a couple months ago, raised my S&P target to 7,500, my NASDAQ target from 24 to 25,000. I left my Dow target at 55,000, my Russell target at 3,300. So if you do the math on any of those, basically, I still think you've got 40% upside in the Russell, probably something like 25 to 30% upside in the other averages. So to me, there's a long runway still ahead. Everybody wants to know timing on it, and I do think it's going to get steeper here, so it could be a top in the first quarter for sure, but if it goes a little beyond that, it's not going to be a surprise, because when I look at my work and I look at a lot of cross-market stuff, there's so many sectors that have plenty of upside from here. So if anything, I think my numbers are going to prove conservative. As I say, I use technicals to some extent. I use fundamentals. Obviously, my strength is my macro, so that goes into it. And then what I call cross markets is basically looking at bond markets, currencies, other stock markets, and as well as sectors within. And so a lot of the cross-market stuff for me is if the sectors underneath the averages are suggesting something that confirms what I see in the averages, that helps me a lot. So, and then of course sentiment. And if I saw everybody, certainly there's a lot more bulls today than there were a year ago, but if I saw, or even 6 months ago, but if I saw everybody talking about the super bullish market, I'd be more concerned. What I see right now is people obviously raising numbers because they're behind and they got to catch up, and they're getting on what I call the bull bandwagon. They're giving you, we're in the season where you get end of 2025 targets. I don't do year-end targets, but a lot of people do on Wall Street. And if you look at it, people go, well, they're coming up with your numbers. 7,000 I saw today from somebody on the street, pretty well-known strategist. And they go, is he copying you? I go, no. Basically, if you do the numbers from here, that's 15%. He's obviously getting more bullish, and he's saying a 15% upside from here seems reasonable. So that's what you're getting. And part of that is because the Fed is now beginning an easing cycle that probably has a long ways to go. And interest rates have finally started to roll back over after backing up. So you got a lot of things going for you right now as somebody on the street that's trying to do this for a living, call markets. You got wind at your back to some extent. They're not crazy bullish. For most of them, I think it's a reasonable judgment at this point to say, yeah, I think the market can go up another 500 to 1,000 points. But as I say, I called it 2 years ago, not just the market, but I said when we get closer to the top, you'll see a lot of people sounding like me. It'll be, for a long time, I was a lonely bull. As you get closer to the top, everybody's going to be getting more and more bullish. Some of it's a negotiating ploy for sure. I mean, the art of the deal, we know who Trump is. He always starts with the most aggressive negotiation. He's going to be showing his strongest hand, and then there's room for compromise. If you start with a weakest proposal, you can only go down from there. So he starts with these pretty dramatic announcements, but they're for negotiation. I don't think you'll see tariffs to the extent that the fears are out there. They do raise revenues. The offset is that it's going to be costly to companies. It's going to be costly, obviously, to our trading partners. However, we are looking to bring back to our shores a lot of the business that we lost, a lot of the industrial output that went to China and went overseas. Basically, the platform they ran on is bringing back industrial America, restoring blue-collar jobs, restoring some of those higher-paying jobs that particularly the Midwest suffered, Detroit and Chicago and Cleveland, et cetera, or the industry that we lost because of globalist policies. That is coming back. So we're going to see a lot of new factory, new capital spending here, and bringing back capacity here that we were dependent on China for. So tariffs are a necessary part of that, and it can be costly, but if that's your goal anyway, is to bring that back. The problem is that it doesn't happen overnight. Those factories, it takes time to build. So in the meantime, higher cost imports does create a problem. Now, where I think people are maybe wrong, or at least overstating, is they say tariffs are inflationary. They're inflationary initially, but ultimately, unless you monetize that, and I do think, the bust is going to lead to monetization of the debt, but unless you monetize that, it's not an ongoing inflation. You get higher prices, you get lower purchases, people back off. There's going to be some give and take on that. So unfortunately, too many of the econometric models are static models or don't do a good job of the offsets. So I think we just have to kind of tone down the expectations there and not be so dire. I think, it's kind of let it play out. I think you're going to be surprised it's not as dramatic as everybody thinks. I just think it's where we are in the cycle, too, that the small cap stocks, which have lagged for a long time, are getting that catch up. And at least for right now, it looks like the economy is on pretty firm ground. So people are, for the longest time, from 2022 until recently, just thinking the other shoe was going to drop on the economy. Rightly or wrongly, I think you're seeing people start to walk away from that. And realize that, there's a longer economic runway ahead. Recession's not imminent, that the economy may actually strengthen, not weaken. I'm not saying that's a correct analysis, but I think that's the thinking on the street right now, or at least that's where we're moving to. I think that'll be part of the run to the top is, there'll be this narrative that the economy's on sound footing or relatively strong. Inflation's coming down. Interest rates are coming down. The dollar is weakening. With the Fed starting to ease, just started in September, that easing cycle probably has a couple of years to run, and therefore the cycle has a couple of years to run, at least maybe 2 or 3. That's not my view, but that's what I think the narrative will be that will take us to the top. Lower interest rates, lower dollar are going to be big catalyst for what I think is going to be a very big metals rally. Obviously, gold's had a great run, but I have raised my target since we last talked anyway. My gold target's now 3,400, had been 3,000. Again, that's what I call pre-bust, basically. And silver, my target is 75. So, we're a long ways from there now. I think the first half of next year, whether most of it happens in the first quarter or how much of it happens in the second quarter, I don't know. But I think basically first half of next year, you're going to see gold and silver have great runs. Gold's had some sponsorship, but silver's really disappointing people for a long time. So there's a lot of frustrated investors out there that don't want to go near it. As the momentum picks up, I think the next run in silver basically had its turn yesterday. I think we basically had the correction. I think silver can next probably run up into the mid 40s, 43, 44. And from there, probably work its way up through the old highs at 48. And then, once it breaks out, I think you have another big sprint to 75. Miners, which have lagged even the metals by a lot, miners have been really a frustrating trade. I suspect we're going to see a strong balance of this year and a strong first quarter for them as well.